Good morning, everyone. Welcome to your Plan B financial planning during COVID-19. We are really happy to have you. We're going to wait just a minute or two to let those of you cycle in, and then we're going to get started. Okay, I can see a lot of you trailing in, so I think we'll go ahead and kick off. I'm Jill Zozula with LSL CPAs, and we are so glad to have you with us this morning. Before we get started, just a few quick housekeeping items for you. First of all, just to let you know, this webinar will be recorded, so look for a link to it later today in your inbox. Our presentation this morning is going to run about 50 minutes, and immediately following that, we'll have a 10-minute question and answer session. So if you have a question for Maria or Robert, please put it in the Q&A box in your Zoom toolbar, and that's next to the chat box. So if you hover your cursor over the bottom or top of your computer screen, the Zoom toolbar should pop up, and that's where you'll find the Q&A box. Also, we're going to be providing you with a recap guide of everything we covered today, so look for that later in your inbox as well. So now let's get this party started. I'd like to introduce our presenters. First off, we have Maria Arriola. Maria is a partner in LSL's Audit and Assurance Department. For over 30 years, she has served clients in a variety of areas, including financial statement audits, reviews and compilations, as well as business and individual taxation. Maria excels at working with clients in manufacturing, real estate, and healthcare industries, and she also heads up our Employee Benefit Plans Audit Department. She leads her department in staying up to date on the ever-changing trends, laws, and Department of Labor regulations. Next, we have our guest speaker, Robert Dalie. Robert is an executive director of investments with the Summa Group of Oppenheimer Co. He is in charge of wealth planning capabilities, one of the pillars the group is founded on. He's been able to differentiate himself by combining a deep level of analytical planning expertise with a strong sense of client advocacy. This allows him to engage with the family on a deeper level of understanding and uncover the real issues and concerns that literally keep them up at night. He takes special care to establish a big picture view of a client's overall goals and develops planning strategies that often includes the input of the client's other trusted advisors, like their CPAs, estate and business planning attorneys, trustees, and banking professionals. Whew, that's a lot. So now I'm going to hand it over to Maria to start our presentation. Take it away, Maria.
Thank you, everyone, for being part of this morning. I wanted to start it off by just saying, okay, the reason I really have Robert and Oppenheimer being part of this is because we've been working with their firm for over 20 years. We absolutely love them. I have all my investment money with Oppenheimer, so just so you know, I'm not just talking the talk, I'm walking the walk. And I wanted to just make sure that you knew why my heart was with Oppenheimer and their group. I wanted to make one thing clear, which is always very confusing to me when I first started with OpCo, is I always thought, okay, Oppenheimer, is that Oppenheimer funds? Is that Oppenheimer? What is this? So one of the things that I wanted to make sure that you knew is it's definitely not the Oppenheimer funds. Oppenheimer funds was owned by Oppenheimer, and in the 80s, it was sold to, I think it was Mass Mutual. And then Mass Mutual in 2018 sold that mutual fund to Invesco. So I just wanted to let you know that is now who we are. But I wanted to go over the agenda today, and I wanted to remind you that the seminar is about you. Robert and I are here to just give you food for thought and provide you with some helpful ideas that will help you with your financial goals. This is a difficult subject, as crazy as it sounds, because even for me, it's a difficult subject because it really hits your heart, it hits you. You know, you're doing really, really well in your life and in your outside world, in your work and everything, but are you really always taking care of your home? And this one hopefully will get you to do that. Again, if you have a financial advisor that you love and you want them to help, this is the time for you to reach out to them and to let them know. Today's agenda is going to be getting your financial house in order, which I mentioned a few minutes ago, talk just a tiny bit about the CARES Act update, credit planning, debt planning, and some estate planning. So Robert, I'm going to hand this over to you so that you can get going on it, but go for it.
Yeah, no, I appreciate it, Maria, and thanks for having me on this this webinar or Zoom call. And we've been working with your firm for a long time too, and love you guys. And you know, just to first start off, it's always good for our clients to have, you know, a top-rated team, whether it's their accountant, their attorney, their advisor, all communicate and work together. And when you're dealing with financial planning, you know, having a solid team in place is step number one. You know, before getting into this, I just wanted to share a quick story. And, you know, because we deal with a lot of different types of families, a lot of different types of clients. And due to COVID, I would say the planning process hasn't changed, but the necessity to review things has definitely changed, you know, in the last couple of months. We have a business owner client down in Orange County. They own a medical device company. And prior to COVID, we were working with the family on selling the company. It was going to be a strategic asset sale. And then, you know, they're, again, in the medical device business. And then COVID hits, and there's this giant wall. The market just freezes up. Their business drops in half. They're considered a non-essential business. And they basically are teetering on losing half of their clients overnight. And after sitting down with them, their CFO, their controller, they were able to come up with a strategy where they were able to manufacture components for ventilators. So they completely pivoted. They had a building that was worth about $12 million that was owned free and clear. And what we were able to do is take advantage of the low interest rate environment to get them a refinance, a cash out, take half of that money and add it into the family's personal net worth or on their balance sheet, take the other half and buy a manufacturing facility that they're able to leverage into building these components for ventilators. Fast forward to today, the company's almost doubled in revenue. Okay, so this was a $20 million business. Now it's a $40 million revenue business. And instead of a strategic sale, what they've decided to do is create an ESOP where they're taking some of their key employees, and because we were able to take money off the table and add it onto his balance sheet and do some, you know, reverse engineer financial planning, we were able to figure out that they actually didn't need as much as they thought right out of the gate. And through the ESOP, they're able to, over a longer period of time, get a better outcome with better tax rates on the potential exit. So that's just an example of how someone could pivot in this type of environment. And we're seeing that with a number of business owners. They're actually kind of reassessing. They froze, they're reassessing, and now there's a lot of activity starting to happen again. So yeah, just wanted to share that quick story. As far as planning goes, getting your financial house in order, the first thing that we like to do is build a balance sheet, and that's really, you know, the same for everyone. We're looking at assets, liability, income, and expense, kind of in those 4 different buckets. And once we go through the process of uncovering what are all the assets, what are all the debts, what are all the income, what are all the expenses, we want to build out a budget, which is probably as painful as going to the dentist and getting a root canal, but you know, it's a really important function, and especially during COVID, if you know you have a loss of income or there's something that's drastically changed in your life, the first thing you want to do is really kind of put those numbers on paper and look at what your inflows and outflows are. It's really important to be able to pivot and figure out what is a fixed cost, what is a variable cost. My fixed cost I can't necessarily change, but my variable cost I can change, and that goes for both an individual and for a business. And then once you have all this information, you know, we want to take it and we want to put it on paper, and we want to put it into a visual format that's really short, concise, and can kind of share the story of what's going on. And that's where you bring the numbers to life, not just having hundreds of spreadsheets, but really putting it into a visual format where we can easily see and digest the information. Okay, I'm going to flip to the next slide here.
Before you go to the next slides, Robert, I wanted to just give an example, and I'm not even talking about an outside example. I'm talking about an example of myself, because putting a budget together is unbelievably a daunting task. I'm sure that for you guys that are listening, oh yeah, I've done a budget or I can get to a budget, but when you're really sitting down, it is crazy difficult. I'm looking at retirement in less than 10 years. I'm scared to do this plan because I'll actually have to be accountable. Oh my gosh, what's going to happen if I really do this plan and I said, okay, what do I have to do? I can't shop at the outlets anymore. I can't fly all over the nation visiting my children and giving them all this money that my husband doesn't know anything about. So it's actually much more difficult. But the beauty about these small efforts is that it does give you a goal. It gives you a direction. It really helps you see how long, and you update it every year. So let's say you have in the middle of the year, like for example, one of my clients, her daughter unfortunately went through a divorce. There was a lot of expenses to do with it. All of a sudden she had to take money out of her account to help the relocation and the attorneys and everything. And now you say, okay, well now I didn't have this expected expense. How does that affect it? Does that going to make me have one less year of retirement funds? So what do I have to do for it? So it really, the action items, it sounds so simple the way Robert says it, but in reality, in your heart, it's very difficult to do. But once you do it, you go, why didn't I do this sooner? It totally makes you accountable for things. And then it also helps you in the fact to know, okay, I work for a large company and I have a lot of stock in that company. This is where I have all my eggs in that basket. And I have some real estate. And I don't really have any cash out here. Well, one of the things that you got to do when you do this with together is you have to be balanced. And a lot of us don't realize what the balance means. What do I need to have in case of emergency? And Robert and his team are actually, thank goodness, when you have people like me that are duds about trying to put it together, I have them and they have my back. So it's important that if you do have somebody, please make sure that you do this. I cannot encourage you enough. Sounds simple until you got to do it, but the accountability is amazing. Sorry, go on.
No, it's great. Yeah, one thing, I mean, again, going beyond the numbers is, due to COVID, people are stuck at home. Kids are doing remote Zooms from home. My kids are. And, when you're kind of stuck in place, you have to kind of rethink what's important, what your values are. And when you're planning, it's not just about numbers. It's about what you value, what you want your life to look like. And the money or the numbers are just going to kind of back up what you want to do. We're seeing a number of people kind of transitioning. They're going up in home, they're going down in home, they're kind of moving around. And this is the perfect time to do this type of planning because, there's no better time than the present. Without going into all the details on this is just a quick graphical slide. 65% of the population, by the way, is visual. So we like to put things into a visual context so that people can digest it. But, for planning purposes, if you're lucky enough, most people have about a 30-year accumulation phase. That's where you're accumulating assets. And if you're lucky, you have a 30-plus year of distribution, okay? So the goal, or the name of the goal here is to try and accumulate enough assets so that you can basically maintain your lifestyle in that drawdown, adjusted for inflation, adjusted for goals and cash flow, and just kind of visually map this out. One point that's not on here that I'd like to emphasize is a lot of plans, what I've noticed, use too high of returns and too short of life expectancies. And there's a great book through MIT's Age Lab that talks about the life expectancy of millennials and Gen X and Gen Z. And the younger generation, they're projecting out that the average child now below the age of 13, half the population is going to live to age 90, which is insane when you think about how much you're going to need to save to be able to afford that long of a life expectancy. So again, use lower return numbers, stretch out the time periods, be realistic about your goals, and just try and, make adjustments along the way. Again, looking at this slide here, going from left to right, you're accumulating assets, you're drawing them down, And, there's really 4 different kind of key variables that you can, kind of model out here. Is you can either try and work on increasing your income, decreasing your expenses. You can change, what age you're going to retire, or you can try and accumulate more assets. So, once you have these different variables in there, you can play around with all the numbers.
Yes,
In planning,
I agree. That's what I ended up doing myself, is with Robert saying, okay, so how much longer do I have to work in order to meet my goal? How much, do I have to accumulate from now? And it really zones you in. Sorry, Robert, didn't mean to interrupt.
Yeah, and we do a lot of this planning also with divorce cases where, unfortunately, one of the side effects of COVID and everyone stuck together is divorce rates actually have started to increase. So, we're seeing cases where, there's a spouse and they need to kind of figure out, do they need to sell the house? How much income do they need? The same type of planning. So anytime there's a life-changing event, you want to go back to the basics and look at everything. Okay, so this, there's a million different webinars on the CARES Act, and I know a lot of people on this call already are aware of most of them. I'm not going to go into the PPP loans or the EIDL loans or any of the loan forgiveness programs that are out there. I just want to talk about the retirement side and just some very specific benefits that you might not be aware of. And even coming into the beginning of 2020, Congress had a bill that passed that extended required minimum distributions from age 70 and a half to age 72, which is kind of nice. It took a half number and it rounded it up to a whole number. So you didn't have to take money out of your retirement plans until 72. And then when the CARES Act was introduced shortly thereafter, RMDs were completely waived for 2020. So that just basically means if you have retirement accounts and you're in your mid-70s, you do not have to take money out of retirement accounts if you don't want to this year, okay? They also included a key provision for what are called hardship withdrawals. And a hardship withdrawal normally used to mean something like, you had a foreclosure or there was something really going wrong in your life and you needed money out of your retirement plans. Now, with the no-fault kind of situation, you can actually withdraw $100,000 out of a retirement plan, and you have a 3-year window to pay back the money without it being taxable income. Okay, so Maria would know more about the mechanics of how to actually do that, but those are the rules that were put in place, and we've seen some people actually take advantage of that where they had a couple $100,000 in their retirement plan, they needed the money, they pulled it back, they're hoping to pay it back in the next couple of years without, penalty.
Absolutely.
Yeah, and this is also a time where if someone due to COVID has lower income this year than in prior years, and they have high itemized deductions, or they have the ability to do small Roth conversions, we're seeing a number of families take advantage of the lower bracket and do these little Roth conversions, which create taxable income, getting money out of tax-deferred accounts into potentially tax-free accounts, because with Roth, you don't get the deduction going in, but you never pay tax, at least as of right now, on the money going out.
Yeah, absolutely, especially in 2020, if your income really has reduced, basically, when you do a Roth conversion, it's a taxable event. It's not just like you're going to move it from one to another, but if you don't have a lot of tax going around in 2020, this would be a good time to do it. So keep that in mind. Give me a call if you need any clarification on that, but that's a very good technical that we've all been trying to do.
Yeah, and another thing that, with $1.5 trillion plus in student loans, we're seeing a number of people who, can't make, their kids can't make loan payments, so the parents are helping out now making the loan payments. There was a federal mandate law that went into effect recently through Trump where basically all federal loan interest payments were waived for the rest of 2020. Now, this does not apply, from my understanding, to private loans. It's only federal loans. So you definitely want to check with your loan servicing company about that. But one quick tip that I want to leave you guys with on that is if you're in a fine situation but you have student loans, what you can do is you can call up. You can have your student loans basically deferred. If they're federal, they're automatically deferred. If they're private, you can still ask the loan service company to defer it, for 2020, and a lot of them will. And then what you can do is you can simultaneously make your normal monthly payments, even though it's in deferment, and on your payments you can write principal only. So it's a way of taking advantage of this to basically pay down principal and use the loan servicing period as a way to knock more principal down. So I've seen a number of people do that.
I have too, and I think it's an amazing idea.
Yeah, and lastly on this slide, mortgage forbearance. I do want to talk about that because there are some pitfalls there. And again, I'm just going to share a quick story. We have a number of clients who actually have significant assets, and I found out they took mortgage forbearance on their primary home loans, due to COVID. So it was no fault. You could just call up your loan service company, say due to COVID, I want to forbear my loan payment for 3 months. Now, a lot of people thought that when you did that, you could tack the loan payment to the back of the loan, meaning you could take those 3 months of payments and stick it back on the back end of the loan so that your mortgage would now be 30 years and 3 months, okay?
Mm-hmm.
Now, that's not necessarily true, and what we found out is that a lot of large lenders, in fact, even though people thought they were required to do that, are not required to do that. And so when you call back and you want to reinstate the loan, what happens is they say you need to either pay it, all up front as a lump sum, or, we can do a workout plan or a loan modification. So in a number of cases, they're allowing them to tack to the back, but in a number of cases they're not. And so that was a huge shock to a number of families when they called thinking they could just, add it to the back of the loan. So I just want everyone to be very cautious and make sure you get it in writing from your mortgage company that they have that ability, and always with these lenders, get it in writing. If you do want to add it, into the loan payment or extend the life, a lot of times these lenders will require you to fill out paperwork to modify the loan, which when you bury through the details, ask for copies of tax return and 2 years of brokerage and all asset and liability statements. So if someone does have significant assets and they try and play that game, they're going to get caught and just have to pay it back in the 3-month period. So far, it doesn't affect your credit from what I've been told. However, the lending companies are not reporting those payments to the credit bureaus. So for a period of time, you're not getting credit shown on your statement. So I think ultimately at the end, it actually is going to affect your credit. Just my personal opinion. And again, I'm not a tax advisor or an accountant, so always talk to Maria and or your lawyer on that type of stuff. Flip into the next page, credit. Again, going into credit, because credit and debit and debt are kind of tied together, and to me, they're kind of the same in the sense that, like, you look at your debt, you look at your your availability of credit, and in some cases we can consolidate loans. A great thing with credit card companies is you can always call your credit card company up if you're starting to fall behind, try and work something out. I always want clients and families to pay at least their minimums. If they can't, maybe consolidate them onto one card and work on that one. There's a really important ratio here for people to know if you want to increase your credit. 35%, there's two ratios. One is 35%, according to Experian and TransUnion, of a credit score is based on your payment history. So you always want to make your payments on time, okay? 30% is based on your credit utilization, and that's just a fancy way of saying how much do I use my credit. If I have a credit card with a $10,000 limit and I have a balance of $3,000, that's a 30% ratio, okay? In general, we want people to have a 30% or below ratio to have good scores. The lower you get it, the better your score is. Once you're below 10%, your score, that's how people get above 800s. So someone could come to me and say, okay, I lost my job or I have no income. I can't pay on my credit, so what do? Well, hopefully while you still have income, one little trick is to actually call the credit card company and ask them to increase your credit line, okay? And they'll do what's called a soft inquiry, and a lot of times they'll increase the line, maybe $5,000, $2,000, $10,000, whatever it is. If someone says no, hang up the phone, wait 10 minutes, and call back. The whole key with this is to be very warm, nice, and friendly on the phone, and just make sure you get someone, and ask them if they can increase the credit. If they say no, hang up, wait a day, call back again. If you're pleasantly persistent and you do this, 90% of the time you can get someone to increase your credit, okay? So my goal for people is to, continually doing that again, whether it's on their personal side and also on business lines. Another thing that we didn't talk about is business credit, and that's using your corporation to increase credit lines, whether it's a C Corp or an S Corp or an LLC. You're going to have business lines that are not personally attached to you but to the business. You want to, in good times, continually increase your credit lines so that you have more debt available to use in bad times, because people will give it to you in good times and they won't give it to you in bad times. And if all else fails, just hire a credit repair company. So it's kind of if someone's credit's below a 600, if they're like in the 580s or somewhere around there, I say just hire a credit company, pay them $1,000 or whatever it costs, and let them work on your credit. One other tip on there, which everyone should know about, is once a year you can get your own free credit reports through the 3 bureaus, TransUnion, Equifax, and Experian. If you go up on those different websites, you can Google them. We have no endorsement on any of this stuff. We don't care. But you can basically go on there. You can set up a free account. You can pull a free report. And then you can look at the different line items and make sure that you don't have mistakes. Make sure that you don't have someone who opened a credit in your Social Security number and it's showing on there. Make sure when you moved, you don't have a utility bill that you didn't know about that didn't get closed that shows as a 90 or 120-day late on there. Those are easy things to fix.
100%. I have a comment when it comes to the business credit. There are a lot of banks outside right now that have given a lot of PPPL loans, which means that they have a lot of money and they are available for you to get more credit. So even if you don't need credit as a business, let's say, okay, Maria, I've already got $1 million line of credit. I never use it. My suggestion is get the highest credit you can, because then your company, even though there's no FICO score per se for business, believe me, there is a scoring that says the higher the credit that you have, the least amount that you use it. And when it comes to business, you have to use a little bit of it. You can't just not use it at all. So you have to, the key is use it a little bit, pay it right away. Use a little bit, pay it right away. And that will give you more and more increase, because like, for example, the example that you have from the very first one, Robert, of that company, in order for them to actually look and pivot and open a different type of business due to this environment, you have to have money available. So you just never know when you need to have that money. I would, and I'm sure that if anybody's on this seminar and know me, I am always telling you to do that. Never close a credit card, even if you're not using, because that'll help your score, and keep up the business line of credits as high as they give it to you. There is another thing too when it comes to business lines of credits. Not all of the loans that you get for business are personally guaranteed. There are different programs that you can try to get from the bank that will limit your personal guarantee. You know how they always want even your youngest son to guarantee your loan? There are a lot of the times that, let's say you're only a 30% owner in that business, you can try to work it out with the bank to say, okay, we have a line of credit. I'm willing to have a personal guarantee, but only on that 30% of what the company owes. So all of those things is something that is all negotiable. And the better your company looks, the better negotiation you can be at.
Yeah, great point, Maria. And two last points here. I forgot to mention, which you just brought up, which I want to reiterate. On the personal side, if you have credit cards that you're not using, yeah, exactly what you said. Don't close them. But also, like, let's say you have an old Macy's or Nordstrom card, that you haven't used in a while. Use it. Put $500 on it and pay it off. Every 6 months, at least once a year, use your credit cards at least once in a small amount and pay it off. Because if you don't, these internal algorithms at the banks will actually close your accounts without you knowing about it.
Yep.
It's happened to me personally too, where we've had accounts and not used them, and they've gotten closed, and all of a sudden that dings my credit by 10 points. And the last point here, and we'll leave it, is, and again, there's no endorsement here, but there's a ton of credit apps out on the market. There's a great one called Credit Karma, and we use it for lots of clients or have them go on there and set up accounts. I have my own as well. You can track and monitor everything on there. It's not perfect, but at least it shows you your two scores fairly close and accurate to what they are. It shows you all your open accounts, and it tracks it on a daily basis. If you have major moves or a new account is open, it'll ping you or text you that a new account's opened in your name. So it's kind of like it's a credit monitoring service, but it's also, for cybersecurity purposes, it's a great tool to have to just kind of track things for you. And the last point here, which again, sorry, I just came up with ideas on this, is for kids. If you have kids, they're under 18, you can freeze their credit. So I know a lot of families that freeze their kids' credit below 18. That way no one can have, basically they're safe from cybersecurity. So no one can open credit in their name. When they hit age, say 17, 18, what the parents will do is add them as an authorized user onto the parent's account, which even though they're not using it, will instantly transfer credit from the parent to the child to start building them credit while they go into college. So that's a great strategy also for anyone who's in a financial pickle and their credit's really low and they need help on a refinance and they're 20 points below. What you can do is have someone with excellent credit add their name as an authorized user. You have to assume they have good credit, and that'll bump their score up to be able to get that refinance or whatever the next level is. So those are just some tips. Okay.
Good one.
Yeah, when you go into debt management, it's similar to credit. You're looking at all your loans. You're looking at your revolving lines of credit. Everyone on this call knows interest rates are at ridiculously historically low rates right now, both for home and for business. And a lot of people have been going down the refinance route, for personal debt and for home loans, for rental properties, investments. So I would say if you've done a recent refinance and your interest rate is within 25 or 50 basis points, I don't know if it's worth doing if you recently did the loan. Also, if you've taken out a loan, and let's say, here's a mistake that a lot of people make is, they did a loan 10 years ago, 15 years ago, a 30-year note, they're halfway into the loan, say their payment's $5,000. At this point, they're paying about half towards principal and a half towards interest. So they're well into the loan, and they're really starting to chip away at principal. And maybe their interest rate's 4% or 4.5%, and a loan broker calls them and says, hey, I can get you a rate at 2.99% 30-year fixed. Okay, sounds great. You're going to shave over a point off your loan, and a lot of people will bite and they'll do the refinance. And what happens is now they did another 30-year loan, but now they were 15 years into this loan. They just turned their initial loan and added another 15 years onto it because they restarted the amortization clock, meaning now all their payments, most of it's going to interest and not principal. So they basically now have a 45-year loan instead of a 30-year loan. So in those cases where someone's deep into a loan, you want to be really careful about refinancing and make sure it's really in the best interest of the client and not just a loan broker trying to sell them on, refinancing to the lowest rate. There is a provision in a lot of loans, not all loans, so you'd have to call your lender and ask them this. If someone has money on the side and they have a mortgage and they want to change their monthly payment, there's a provision called a recast. Again, it's built into a lot of new loans and some old loans where you can call your lender up, pay a small nominal fee, maybe $200, and I could take a chunk of money, 50 grand, 100 grand, and I can pay down my mortgage. And let's say I had an $800,000 mortgage and I paid $100,000 to $700. Now my payment would drop from, let's say, 5 grand to 4,200. My term stays the same. It's the same length. My interest rate stays the same, but I just knocked my payment down and help my cash flow. So look at recast, look at the length of the mortgage. Again, if you're relatively new into it, a couple years in, and you can shave a half point or more off, then yeah, go for it. Just make sure you get, again, in writing what all the points and fees are through Truth in Lending. This has to be disclosed by the lender, and just make sure you're not getting gouged, with the points going in. So again, that's on the personal side. On the business side, again, a lot of business owners are refinancing, they're pulling money out of buildings, they're doing cash outs. So these are all things that in the planning process you want to look at not just your assets, which most advisors do, but you want to look at the liability side of your balance sheet and figure out, again, based on COVID, based on interest rates, what is the best option for you to take advantage of this market. So a lot of activity there, tons.
I agree. And there are a lot of lenders that you can do online now that they don't charge really any fees, because that's one of the things that a lot of the younger generations are not getting. They're getting refinanced, and they're not looking at the fees because they just add them to the loan. Well, adding them to the loan, that just means you're going to owe it. So really, you have to be careful. There's a lot of things to be done. If you don't plan to be staying at that house for more than 5 years, don't go refinancing, because it does take a while in order to pay off those items. So just be aware of all that.
Yeah. And one final point, and I'll flip to the next slide here, is going back to that 30-year loan scenario. Let's say someone's halfway in there. They're 15 years into a 30-year note, and they're in the mid-4s on the rate because they took it out a while ago, or maybe even higher, is if you can refinance into a 15-year, so you're keeping the same time period, the same duration, but at a lower rate, what's going to happen is your payment's going to be lower. So over the life of that last 15 years, you're actually going to pay less in interest. You could potentially save 50, 60 grand in interest on the note, but you're having the same time period. So whenever you're refinancing, if it's your forever home, you want to keep the length of the term relatively similar to what you have. Otherwise, you're just paying debt forever.
Yep.
Okay. Yeah. One more slide on debt here, and that's just, again, I won't get into it. I'm not a lawyer, but there's a lot of new rent laws here in California. There's a national moratorium on evictions and foreclosures. So like if you are in distress, both personally or in a business, I would say the best bet here is just to be upfront and honest with your landlords, reach out to them and just explain your situation, and not try and hide anything, because it'll come back to haunt you. And in emergencies, again, these are emergency situations. Going back to the budgeting, first thing I tell someone is if they lost their job or their business shut down is, create a budget, figure out what your expenses are, and then break them apart into fixed and variable. And then in those variable expenses, look at your luxury items. Like we all love the Ubers and the Grubhubs and the delivery service and food service that comes to your house. But if you're in an emergency, that's the first thing that's got to go. You can keep water and some essential food things, but like all the web services and kind of luxury item things that we get delivered, you got to stop that, at least in the short term, and kind of, cut the pain. So, okay, estate planning. This is kind of the last slide here. There's actually two parts of it, but I'm sure everyone aware is that, both the tax and regulatory environment continues to change. Right now, we're sitting at an exemption amount for estates. For an individual, $11.58 million. For a married couple, that's roughly a little over $23 million, which means that if your estate is below $23 million and both husband and wife pass away, potentially that estate is estate tax-free. Okay, that law sunsets in 2025 if nothing's done by Congress. And again, it doesn't really matter. I think no matter who wins presidency in this cycle, at some point our taxes are going to go up. It's just a law of numbers, large deficit, large spending. We're going to have to pay for it. So estate tax, income tax, this stuff is all going to potentially go up. One of the tips here, tip number 5, is just if you haven't given any gifts and you have a large estate, or you have more and you've done planning, and this is why planning is so important, you've done the financial planning, you figured out that you have enough in a safety net or carved out as income in a portfolio from different income sources that you can live the lifestyle you want to and do all the things, and you have this huge surplus. You have kids, you have families, you have charities that are important to your life. Maybe now is the time to kind of look at doing some gifting or taking advantage of removing some of that excess portion from your estate and getting it out of your estate now and into different vehicles that are going to go to your loved ones and to your charities in a very tax-friendly way. So there's a lot of planning that goes on to this. I'm trying to really simplify this, but it's just something that everyone should be aware of, and at some point in the not-too-distant future, statistically, it's probably going to decrease. So,
I definitely agree, especially if the political win in November, depending on what it is, even if income taxes will go up, which I think it will, no matter what it is, who's the president, the estate exemption, I'll tell you, the general, pretty much all the attorneys that I've spoken with, the general consensus is that's going to go down. It's not going completely away, but it may go down all the way to 5 million a person. So this is 2020. This is the good time. If you have, especially if you have real estate that you don't need the cash flow for, if you can set up family limited partnerships, if you want to, I mean, obviously you want to continue to be completely involved in running it and all that stuff. There's so many, there's defective trust, there's so many things that you can do to make sure that we use up all of this $23 million as a gift. Is basically what we're saying. We're saying is use it up right now, because when it's gone tomorrow, they don't go back and tax you on that. So you do the gift, you use it up. If at some point in time in our lives, it will go above 23 million, that's great. Other than that, you're not losing anything. So lots of estate attorneys are extremely busy, pretty much waiting for, let's see when that shoe is going to drop.
Yeah. And yeah, just to kind of tie this up too on gifting, which Maria just talked about, and charitable planning. There's all kinds of different entities you can use: CLTs, CRTs, GRATs, non-grantor trusts. These are all just fancy names for different gifting and estate planning tools that we use. If you have a business that's rapidly growing, or you own stock in something that's rapidly appreciating or has very low basis, taking advantage of not only the ability to use that higher gifting amount, but also there's something called the AFR rate, which is the applicable federal rate that they use for estate planning, and that rate is based on current interest rates. And so that rate is so low right now, it's historically, on the very low end of the range, that like if you're using these vehicles and you're putting money into them, not only are you taking advantage of gifting, but you're also kind of taking advantage of a hurdle rate being so low that like anything above and beyond that, with growth, it gets pushed out of your estate. Again, I'm not an attorney, so I don't want to give tax advice here.
No, and I'm the same way, but I mean, here's another one that it goes from estate planning to income tax planning. I'm sure that you guys are all aware, being in the state of California, it's beautiful here, but at the same time, well, maybe without the fires, let's just pray to God that those things get taken care of. But basically, there's a tax proposal out there that's pretty extensive. The most important ones is that the income tax rate for California is going to go from 13% to almost 17%, which means that if, let's say, you do have rental properties, and if you're getting taxed between 17% California and 39% federal, they're taking a lot of dollars. If that rental property can be gifted to your child, their tax rates are so much lower. And if you are not in need of that rental, this is a good time to pass it down. There's also a potential proposal to having a wealth tax on anyone that has over $30 million of assets. That's never even heard of in our nation, ever. Now, not everyone thinks that that's going to go through, but it's still at 0.4%. They're going to be charging you on your wealth. So it's basically estate tax while you're alive. So stay tuned on that one. I'm sure we're going to have a lot of we already had a seminar, a webinar that's on our website too, if you guys want to know a little bit more about the California tax law changes, but that's coming, and it has some pretty big potential tax issues. That's another reason why do estate tax.
Yeah, there's potential loss of step up in basis. That's $1 trillion issue.
Yes.
Now, who knows if that? I mean, these are all proposals out there. Who knows if any of these things actually happen?
Who knows?
One tip on there, which I didn't put on there, but like any new client that we take on, one of the first things we do when we're onboarding a client is we're looking at statements and we're looking for missing cost basis. Okay, this is going to be a huge issue if this actually happens. So if someone has a loss of step up in basis at death, what it means is that, like, we're going to have to track down, every advisor in the United States is going to have to track down cost basis on any missing statements. So we might as well work on that now, because how are you going to figure out what the basis is? So that's going to be a major problem for banks and brokerage firms if that happens, because old records from grandma who owned AT&T 50 years ago probably got thrown out and no one has a record of the basis. Okay, I don't know how that's going to be dealt with, but two last points here is I call the California migration. I've been doing this 20 years plus now, and I've never heard of so many people talking about residency planning. It comes up all the time. And just so everyone knows, California is a domicile state, meaning California taxes you based on where you're domiciled, not where you reside. So again, these are advanced things that you definitely go to a CPA to have a residency audit and make sure you know what you're doing and have someone who knows what they're doing in this case. But if someone's going to leave the state, I mean, they legitimately need to do it, and they need to change everything to the new residency, so their domicile, their tax returns, their voting, their dental, their cell phones, everything has to be out to make it, 100% legit. And then some people are keeping a secondary home here and then living out, say 6 to 10 months out and then 2 to 3 months here in the state. Again, these are all complicated issues. Just make sure you talk to your CPA, someone like Maria who knows what they're doing in this space, because the California State Franchise Board will audit you.
You know what I always think about California? I visualize it as an octopus.
Yeah.
I mean, we're pretty poor, so they're going to try to get it from everywhere you can. It's not as simple as I want to get a house in Nevada. I mean, it's not just even a driver's license anymore. It is insanely a huge amount of steps you have to take. Again, we actually have another webinar that I believe also goes through that for the California if you're moving to another state. It's quite a drama. So we definitely have to have all of our ducks in a row so that we don't have that octopus coming back and taking their money.
Yeah. And I'll just, final point here is, we deal with a lot of money in motion events. Our team, we're a 12-person team. We manage north of $2 billion, but there's a lot of liquidity business owners who are going to sell their companies. If the market froze up, now they're kind of coming back, and we're seeing activity pick back up, and they're realizing I need to sell. So there's a number of business sales, liquidity events. There's been a number of deaths just because, mortality, divorces that have gone on, not just due to COVID, just kind of gray divorces, and just major life-changing events. And I would say now, or during those events, but also now, planning is even more important than it's ever been. And you just want to make sure you're with a team who, first and foremost, shares the same values, cares about you, understands you, and has the kind of technical expertise to solve all these issues. And with that, I want to open up for Q&A if anyone has any questions.
Thank you, Robert, by the way.
Yeah, my pleasure. Okay. So I see one question on here. Is it better if you have the choice between planning for retirement or paying for your kids' college, which would you prefer, or which would you recommend? Okay. So in that case, a lot of people would think that it might make more sense to pay for college first before retirement, but I'm kind of here to argue the other side. And the reason is no one's going to finance your retirement, and there's unlimited student loan resources. So I would say to that comment is you'd always want to plan for funding your retirement accounts first before college. I mean, 529s are a great vehicle. We recommend them for all families. But if you have the choice and you can only do one or the other due to COVID or income dropping, you want to finance your retirement because you can always borrow for college.
Agreed.
Yeah. Any other questions on here? Looks like my box froze up a little bit. Maria, do you see anything in there?
No. Jill, can you help us out?
Yeah, I see one that says, how often should I be meeting with my financial advisor? in light of all the current changes?
Great question. So it's interesting. You know, it used to be you would meet quarterly, and I would say, depending on your specific situation, I mean, I would say even more frequently. And, you know, the great thing with Zoom and just technology and the advances of what just happened, so on one of the flip positive side is we just took 5 years of technology growth and shoved it into 5 months, is I can get on a Zoom call, or we can get on a Zoom call and talk to a client, you know, face-to-face through Zoom anytime we want. So the more communication, actually, the better. When we initially onboard somebody, we're talking like weekly, and it kind of spreads out over time. It goes monthly, quarterly, but during stressful events, when you need your advisor to be there, like in March and April and May, when the markets were just going haywire, we were talking to our clients daily, weekly, like whenever they needed us. And that's just important. You just need to know that you have access to your advisor anytime that, you know, you really have issues.
Well, and I'd like to make a comment on that. I think a lot of the times we don't connect our advisor with our everyday. With all of these kids coming back home, I have a lot of families that are not necessarily in their 30s, but they're now have the kids back, and now there's no space for them to work. There's no, okay, I got to go buy a bigger house. I got to go spend that. But they're less than 15 years away from retirement. Is that smart? You know what I mean? And you get in the groove of being, okay, I need to solve today's problem because I feel like I'm getting really stressed and all that. And that makes sense if you have the funds to take care of your retirement. But if you go up higher and you have a bigger mortgage and now you start putting less money in your retirement and you've got 15 years to go, you're going to be in a pickle. Yes, a lot of people would say, well, my house can sell for later for that much. Well, I just hope you're not in a 2018 when that happens, because you never know about this darn house market. Right now it's out of control, but 10 years ago we didn't. Who knows where you're going to be in 15? I'm just saying that as you get closer to retirement, having bigger and bigger debts, it's a real detriment, because the idea is, so if you sell it when you retire, where the heck are you going to go live? You know, I don't know about you guys, but compared to the house that I bought, that's a 5,000 square foot home, today a 2,000 square foot home is more than the house I bought. So I'm just saying that getting into additional debt should be something you should be dealing with your financial advisor. It sounds crazy, but it's so connected that you really should be able to talk those really big issues with your financial advisor. And if you could with your CPA, I would love that. You know what my answer would be, but if you're going to talk to them.
Robert, another one came in. How long is it safe to stop putting money into my retirement to pay current bills before I jeopardize my long-term goals?
Wait, can you repeat that one more time? I'm sorry.
Yeah. How long can I stop contributing to my retirement to pay current bills before that jeopardizes my long-term goals?
Okay, so in that case, I mean, there's a lot of missing information to kind of answer that correctly, but if in the short term, you know, someone has distress and they have, again, the choice between retirement planning or paying bills, you want to pay your bills. I mean, you want to keep yourself current and, you know, deal with the now. You know, long term, I mean, you don't want to do that for years, but if it's short term, you know, during a stressful, you know, time like this, then yeah, absolutely, you pay your bills first and you stop your contributions. Now, to really kind of dive into that, you would have to kind of look at their balance sheet, look at what they're spending, and figure out, like, when do they want to retire, how much money do they need in retirement, what income sources they have, and then I can be very specific about answering that question.
And what's considered necessary bills? Yeah. You know, that's another thing. You're paying your bills now, but 5 slices ago, we said, okay, should we be really doing toll road? I mean, I don't know about you guys, but my toll road is it's a car payment. that I pay on the toll roads. So can I get out of doing that? Because let's just face it, we're not using it that much and we're working from home. When you have a lot of other additional fees that you've used because you were, you know, that radio and that this and all this additional stuff that you do on your, that you have used, you don't have to do that. So I think a part of it is not just your, what do you need to pay, but not to say, okay, I want to go buy a car. Should I do that when my car still has life in it? It's what I'm saying.
Yeah, I see another question about Social Security. Should I take Social Security early or wait? And so my answer to that is, as long, okay, so there's two parts. As long as you're healthy, you don't have any major kind of medical issues. Sometimes it makes sense if someone has some major medical issues to take it early, but like in general, I always tell people kind of delay it as long as possible, because after full retirement age, which depending on when you're born could be like 66 and a half, somewhere around there, 65 to 66 and a half. Every year you delay Social Security all the way up to age 70, you get an 8% increase in your payout.
Correct.
So 8% times, 8% plus 8% plus 8% all the way up to 70, it's potentially a 30% increase in your payout. Now, one would argue that, like, okay, if I delay, that benefit, how long do I have to wait to kind of like make it up? And the break-even age, I've done this 100 times now, is age 82. So if someone thinks they're going to live past age 82, you wait till age 70 to take it, and then anything past age 82 is all extra income. If they live into their 90s, it's to 100, it's a lot, actually quite a bit more. So I don't think Social Security is going away. That was part of the question. I think it could be means tested. You could remove the cap and make it taxed like like Medicare. I mean, there's a lot of things that are very politically unpopular that could happen to it, but I definitely don't think it's a safety net. It's going away. So that's that.
Yeah, Robert, another one just came in. What are some options when you finish paying your home? Would it make sense to buy a rental property or invest in another type of real estate?
Okay, so if you're done paying your home, so again, it goes back to what is your big picture goal? Are you trying to create another income source? And if the answer is yes, then looking at an asset allocation, are you fully invested in the markets? Do you have a traditional stock and bond portfolio? Do you own some alternatives? Do you own other real estate? How heavy are you in real estate? If that's all you own, then I would say you want to diversify and own stocks and bonds, because diversification is the only free lunch you get in investing. But if you're all in stocks and bonds and you have your 401k and you're maxed out and you have all that stuff, and you own your home but you don't have rental, yeah, having some rental property is a great investment. You get depreciation, you get income. I would say, just be careful about the timing and where you buy, and make sure you do your homework on what you're getting yourself into, because I know a lot of people that own duplexes and 4 units and portfolios of income, and they accidentally got into the landlord business. So my advice is, if you don't want to be hands-on, use a property manager and just pick your spots and maybe
Absolutely.
talk.
And I think and to top it off, what you said at the beginning, Robert, is until you have built a nest egg of investment portfolio that will get you through a year, then don't go into an asset that's not as liquid. Now, like Robert said, if you already have your 401k, if you already have, your nest egg of investment, if you've already got all that, then 100% you should, supplement that with a rental property. That's be awesome.
Yeah, you just got to be careful. I mean, the market's been hot for a number of years. Interest rates have been low. Who knows where it goes? Prices are sky high right now, so you just got to be very careful where you buy. What you make your money in real estate on the buy. So can you get a good deal?
Real estate market right now, it's hot. Mm-hmm.
Yeah. So at some point it's cyclical, and we'll have a correction. Nothing goes up forever. It always has some type of pullback. I don't see any other questions or.
That takes us right to 11 o'clock. So we wanted to say thank you so much, Maria and Robert, and most of all, thank you for spending an hour with us here. Wanted to remind you that you will be getting a follow-up guide emailed to you later today. That is a nice compilation of everything that Maria and Robert discussed. Also, we have a wonderful free spreadsheet on our website for you. If you go to lslcpas.com/webinars and look for our cash flow webinar that we did last week, we have a wonderful Excel spreadsheet there that will help you actually plan out your cash flow. So most likely scenario, best case scenario, and worst case scenario. So make sure you go over to the website and pick that up as well. Thanks again for joining us, and we really appreciate it, and make it a great day, everyone. Bye-bye now.
Bless everyone. Thank you.
Bye.